7 ways to manage a bull call debit spread. We have videos on this and the 8 ways to manage a bull put credit spread and 8 ways to manage a bear call credit spread and the ways to manage a bear put debit spread. But let's go ahead and take a look at this. So a recent presentation back in January 2022, we did review the 7 ways to manage a bear put debit spread. You can follow the YouTube link there, jot it down or take a screenshot and check that out later on if you're interested in that. Or just simply go to the YouTube channel, go to Bear Put Debit Spread playlist, and you can find the 7 ways to manage a bear put debit spread. And previously, back in December, we discussed stops on debit spreads for Lisa. And Lisa had asked, well, use the same stops on a debit spread that you might use on a credit spread. And of course, you can take a look at that presentation there on the debit spread playlist on YouTube as well. But we'll review some of that just now. So what is missing from all of that? Well, the full presentation for the 7 ways to manage a bull call debit spread. Now let's take a simple in-the-money bull call debit spread. Of course, we know we can trade in-the-money bull call debit spreads that are parity trades to the bull put credit spreads, which are out of the money. Or we can trade sort of an at-the-money or out-of-the-money bull call debit spread that has closer to a 1-to-1 risk-reward ratio. When we're talking about the in-the-money debit spreads, let's go back to March 21. This is a bull call debit spread search that was run on March 21st using the historical tools today, and KSS came up, Kohl's. Kohl's on March 21st was trading at 62.05. We could sell to open the in-the-money 57.5 call for a premium of 553, and buy the deeper in-the-money 14th of April 55 call for a cost of $730. This would give us a net debit of $177. So on our 2.5 point spread, the maximum return if the stock stayed above both strike prices, we'd buy shares of stock at 55 to deliver on our obligation at 57.5. We'd get $2 back. So we'd have a profit of 73 cents on our investment of 177 or 41.2% return. The probability on March 21st of coal staying above 57.50 was about 75.4%. Now, over the last 10 days, coal sort of did fairly well. It started to trail off of this jump that it had, likely due to earnings, but then the last 3 days, it really took a jump down in price. In the last 3 days, we've seen it get near to those prices there of about $58, $59, and even dropped a little bit further there down to $57.99 at one point. Remember, we had the $57.50 strike. So right here was about the day that it really went bad. What are the basic stops we might consider using when we put on a debit spread of this type? Slightly in the money, high probability, 75 to 80%. Well, our basic rule that we would use for debit spreads, as we would use for an out-of-the-money bull put credit spread, is the 1% rule. If the stock reaches within 1% of that short option strike price, the short call that we sold in the bull call debit spread, the short put we might have sold in the bull put credit spread, we might consider managing the position. Remember, we started out pretty far out of the money. The stock was at 62. We were at the 57.5 strike, about 5 points out of the money or so. It's about 8 or 9% out of the money. But now at this point, we're getting near that 1% rule. The stock's going in the opposite direction. So we might want to consider management. When we open a bull put or a bull call debit spread, we're likely looking for a stock to be trading in the desired trend. Stock to be trading above the 50-day moving average or the 20-day moving average. Or we might have looked for a stock that had a positive MACD, where the MACD line was above the 9-day EMA, looking for a positive trend. We had that when we opened this position. But now the stock has moved below the 20-day moving average, and we start to see that negative crossover just a couple days before the stock jumped down below the 20-day moving average here. If you use different technical indicators, if you use Fibonacci, or if you use on-option volume or things of that nature, you'd want to look for the same things. If the trends that you use for technical indicators start to change, they go negative from when you open the position, that should be an alert or a warning sign that it might be time. You might want to start looking to managing the position. The big one we typically look at is if the position, credit spread or debit spread, is at 50% loss if we liquidated. Remember, our debit for this position was $1.77. So in that case, at about 88 cents, 89 cents or so, if our liquidation loss was 88 or 89 cents, we might look to close the position to avoid further losses. Taking a 70% loss or an 80% of the maximum loss, we want to control that to the 50% loss limit on the trade. So those are some of the trigger points we would consider. And as we saw, most of those were triggered on April 6th when the stock closed at 57.99. Our 1% rule would have been at 58.07. We were below the 20-day moving average. We had the negative MACD crossover, but we weren't yet at a 50% loss, but we're going to take a look at that as it is. Okay, so what are our 7 ways we might look to manage this position? As we mentioned, on April 6th, closed at 57.99. And we had our 2 other alerts triggered. Management 1 is do nothing. We're going to pause for a moment. We're going to take a look at the position. What happened in those last 4 or 5 days leading up to this pullback where we hit the 1% rule or even dropped a little bit below that to 57.99, though we still weren't below our sold call strike of 57.50? Was it related to market conditions? Was the whole market down and everything was being brought down? Meaning I still feel my stock is relatively strong in its sector. I feel my stock is still an outperformer in the sector or in the industry. And it was just a few days down in the market that brought it down. Now, was it the stock itself? Did some news come out? Was there some mention of perhaps earnings, or did a competitor have an earnings that was negative and that brought down everyone else in the sector itself? And also, what is the sector as a whole doing? Why was it the downturn? Was it just market related and I think it's going to stable and move back up? Or was it related specifically to the stock, which usually means that's a higher warning and I should consider getting out? And what are the new expectations? Was this pullback an overreaction to something and I feel it's going to stabilize and recover? Or do I feel that this is now changing direction and changing trend for more of a pattern with only 8 days to go to the 14th of April? This was on April 6th, remember? So with 8 days to go to April 14th, should I consider to adjust the position? What are the pros of management number 1? Do nothing. Well, you have the potential for profit as expected if the stock does stabilize and start to move back up. What is a con? Well, if this trend continues down and we don't take action now, we could suffer larger losses on the position. When would I use management number 1 of do nothing? Well, now that there's been a pullback, my market sentiment is stable to bullish. My underlying stock is going to stabilize or it's going to start moving back up, and I'm going to get closer to the expected return I wanted in the next 6, 7 to 8 days. Management number 2 is liquidate. We've seen the triggers, the alerts hit. We don't want to overthink it. We don't want to try to over-adjust it and put ourselves in a worse position. Let me just get out of this position, move on, and make it up somewhere else. On April 6th, when KSS closed at 57.99, the midpoint prices, we could buy at close, that 57.50 strike we sold for $1.87. We could sell to close the 14th of April 55 call in our Bull Call Debit Spread for a price of $3.38. This would give us back $1.51 for liquidating the debit spread when our alerts were triggered. So we'd have a small loss of 26 cents. Because remember, we paid the $1.77 debit. We only got $1.51 back. So we'd have a loss of 26 cents, or about 14.7% of the maximum loss. To be honest, I probably wouldn't have closed this position just yet because it wasn't near that 50% rule. Yes, it's near the 1% rule. Yes, I'm seeing the stock trading below the 20-day moving average and we have a negative MACD. But right now, it's not yet at a 50% loss or even at a 30% loss, so I might not have liquidated here. But the pros of management number 2, liquidating the debit spread, we're out of the trade with a small loss. We only have to make up 26, 28 cents going into some of the next trades or the next trades we open for the next cycle. The cons, of course, we miss potential profits if it recovers, and it does go back to where we expected it to go originally when we open the trade. The sentiment to liquidate when you use management number 2 is you're now bearish on the underlying. Sentiment has changed since you opened up the trade, and you're looking now to limit losses on the position, to control the risks as best you can, and move forward going on into those new trades. All right. Management number 3. Roll the short option only. Now, what do I mean by roll the short option? Remember, we sold the 57.50 strike and we bought the 55. What's being threatened as the stock declined? It's our short option and, of course, the max payout that we want in the debit spread position. This adjustment will only work if you left a strike between your two strike prices when you open the trade. If your stock or your underlying had 1 point strike differences or 2.5 point strike differences, and you just did a 1 point spread, you just did the 2.5 point spread, that's still fine, but you won't be able to use this adjustment. In this case, now that the stock had pulled back to about $58 on April 6th, as we saw before, we could buy to close the April 57.50 call at 187, and we could sell to open the same expiration, 14th of April 56 call at 292. Those are the midpoints at the close. This gives me a new debit of only 72 cents. We're taking in another $1.05 here. You know, the $1.77 already factored in that initial $5.53 premium we received here. But by closing this at 187 and selling to open this new one at 292, we get an extra $1.05 credit. The $1.77 has already been accounted for, so we have a new net debit of 72 cents. But we're in a 1 point spread now, not a 2.5 point spread. So the max return we can get, if it stays above 56 now, the new sold strike price that we rolled down to, we'll get $1 back. We'll make 28 cents, and this is a 38.9% return against the new risk of 72 cents. Over here on the graph, it only shows a 12.6% return with a position here of buying this option, our original 57.50, and selling the new 56 strike. And that's because it's reading we need $1.50 here to cover the margin requirement, which we don't really need. This was actually a closed position, so that's not required. We have a 72 cent debit for a new 1 point spread, max return of $28 against 72 invested. There's our 38.9% return on the position. The pros of this adjustment is we also managed to lower the break even. Since we lowered the strike price, now we have more room. The stock can fall to 55.72 before we hit break even, where before it was at 56.77. We increased the probability. And what I mean by that is not from the original position, but from where we stood when the stock started to fall. The 57.50s that we had originally sold, that probability is now down to about 53%. The 56 is about 68%. So we're increasing probability in our favor of this expiring worthless. We still can keep a potential profit on the position if available. It won't be available at all times, but if the profit's available, we're still going to be able to keep a potential profit with a better break even. And we also effectively lowered the risk in this example down by more than half, essentially. So we take the risk down a lot. But that's also going to lower the monetary profit, where originally we expected 73 cents of potential profit. Now we're only seeing 28 cents. And although we lowered the risk, if the stock continues down, we can still lose 100% of what we invested into the position with that new position that we have open. The sentiment for this management, just rolling down one strike to give yourself a better break even and more room, is that you're neutral to stable. You expect maybe the stock to be hesitant, but you don't expect any more further declines by another 1, 2, or 3 points. And again, this is best used if you still have 5 days or more to expiration. This is not an adjustment that you should do when you have 2 days left to expiration or 1 day left to expiration. This is best used, a lot of these are best used if you have more than 5 days to expiration. All right. Management number 4, the most common approach used by investors. Not saying it's the most preferred or the best one to use. The best one usually depends on the circumstance. Just roll the spread out. We had a spread position. It's being threatened because the stock is going in the opposite direction now than when we opened the trade in our initial sentiment. Let me close this position, keep trading bull call debit spreads, but just go another 2 to 3 weeks, maybe a month out in time, and go to lower strike prices to make it up and have a better probability. Well, you're rolling it, but technically we can look at it this way. Your first step here is you're liquidating still the initial position. We're essentially going to buy to close the 57.5 call and sell to close the 55. We are rolling them to lower strikes, but what are we going to do when we close that position? We're still taking the 26-cent loss that we saw from management number 2. Now, we're going to go out in time and go to lower strike prices. We could sell to open the April 53 call for $5.90. This was on the closing prices of April 6th for the 29th of April expiration. We're extending the trade by 14 days. All right, 15 days technically, with the markets being closed on April 15th. But we're going 2 weeks out in time. So we're selling to open that 53 at $5.90. We're buying to open the 51 call at $7.48. This gives us a new net debit of $158 on a 2-point spread. So we still have the potential to make $42 or 26.6%. We would do this when our sentiment is the underlying is weak, but not likely to breach these lower prices. And we're fixating ourselves sort of on managing this particular stock. In other words, we opened a bull call debit spread on KSS. We're going to manage it until it's profitable. So we're deciding to roll down the spread. This is good to use if 3 is not available. The one we just talked about is just moving down the short strike, 1 or 2 strikes to have a smaller potential profit on the position, but give yourself a better break even. If that adjustment doesn't work out to where you would have a profit where it would look like a loss, this is a solution when management number 3 is not available, or if we're too close to expiration where management 3 wouldn't work. In other words, we're 2 days, 3 days to expiration. There's no premiums available on those strikes with just 1 or 2 days to expiration. This is when we would consider just rolling out the spread in this case if we were focused on fixing this particular position on this particular underlying stock. Okay, so that's when we would use this one. Now, what is missing though? Something's not right here. What we were missing in number 4 is we didn't account for the 26-cent loss we were taking from closing the position. We still had our debit that we saw there on the last page of 158, but now we have to calculate in the loss of 26 cents. So our true new net debit on this position is 184, which means on our 2-point spread, the max return we could see is 16 cents or 8.7%. Again, the pros of just rolling out the spread. Closing a position that's being threatened and your alerts have been triggered, it's within the 1% rule, or it's losing, maybe it's losing more than that 15, 20% that we saw. We're going to be able to lower the break even of the position. So now we're taking it all the way down to 52.84, where our break even on the original position was 56.77. We have a similar monetary risk. It's a little bit higher in this case, and we have the potential to turn a losing trade into a winner with just a little bit more time. But it's going to result in a lower monetary return and a lower trading plan. I'm sorry, a much lower monetary return and percentage return. Got ahead of myself. And then I mentioned trading plan. Why? If my goals and my trading plan for this strategy in my portfolio is, say, to make 12, 15, 17% every 2 to 3 weeks, I've just extended an original 3-week trade out another 2 weeks. So it's a 5-week trade, and the maximum profit is 8.7%. Is that better than taking a loss? Of course. But am I thwarting my trading plan and ruining my potential plan for expected gains by doing this adjustment or moving it out too far to take a loss to a profit? That has to be considered when you do this, because you don't want to have to roll out 2, 3, or 4 months and realize you're wiping out too much time in your trading plan to achieve the goals you want. It might be better just to liquidate and take the loss, and then on your next cycle, start making it back with the 2, 3, or 4 other spreads that you're using in that portion of your portfolio to hit the targets that you want. You'll make it back up faster that way usually, than just forcing yourself to roll 2, 3, or 4 months out in time. And of course, we can still result in a loss, and the loss is a little bit higher. So if the stock continues down, usually when you have to roll that spread out, if the stock continues down, then in that case, you might see higher losses on the position than you originally planned. To counter that, you could increase the strike prices, the strike width, I should say. If we go with a wider strike width, that might bring in more potential profit when we're closed out at the end, or we could increase the contract size. But both of those will require more risk in the trade that we're taking on this position because we either increase the contracts or we increase the debit cost because we widen the spreads on the position. That is one way to make back more monetarily, both increasing the contract size and increasing the spread width, debit spreads or credit spreads, but it comes with that extra risk if the stock continues to move against you. All right, now, management number 5. We had a bull call debit spread. Stock started to move against us, got near our short strike prices and our other alerts. We could create a Condor. In this case, we'll add a bear call credit to our existing bull call debit spread, and this will give us an all call Condor position. We could sell to open the April 60 call for 78 cents and buy to open the same expiration because we have time. We have 8 days, 14th of April 65 call at 35 cents. This is going to give us a new net credit of 43 cents to our position. So what is that going to do? That's going to lower our break even. We're going to drop that lower break even down to 56.34 from 56.77 with that net credit. It lowers the total debit into the position from 177 down to 134. The cons of this is it now creates an upper break even. We have 2 ways to lose. If the stock does start to recover and swing back up, well, in that case, then we could start losing on the upside. We would have been back again at full profit, of course, on the bull call debit spread. And because we're adding a bear call credit spread, in this case, I used the 60 and the 65 strike, we have to put up the 5 points of margin. So now the true risk actually increases up to about 384. If the stock really took off and really recovered, and the next 5 or 6 days is up at 65 or 66, I'm losing 384, more than double the original debit of 177, or the max risk, I should say. But we do increase the monetary max profit up to 116 from where it initially was at 73 cents, excuse me. The sentiment to do management 5, create a Condor and a debit spread, is the underlying is stable after this recent move, and it will not breach either sold option strike price. As with the others, number 4, you can do this when it's only 1 or 2 days left, but number 3 specifically, and one we'll see later on, you should do this with 5 or more days left. If you're trading a weekly, you might be able to do it with 3 days or 2 days left, depending on what credit you can get. Why did I make this a skewed Condor where I have a 2.5 point debit spread to the downside, or the bull call debit spread is 2.5 points here, and this is 5 points? Is because the premiums were so close on April 6th that the 62.5 call was only a net credit of 18 cents. It wasn't worth it. I wanted to get a little bit more, so we had to increase that to 5 points, which you see the risk there. It increases the maximum risk to almost double where we were before, because to get a reasonable net credit, we had to put in a 5 point spread on April 6th to do this. Now, a comment always comes up when we present the idea of using a Condor to fix a debit spread or to fix a credit spread, and that's why not get more premium by creating the butterfly. Well, that is management 5B, is to create a butterfly. Same approach, but we're going to sell the exact same call we originally sold. Now that it's April 6th, remember, it's going to be a different price, and we're just going to buy the same width apart on a higher side. We're still entering a bear call credit spread, but to create the butterfly, we'd sell the 14th of April 57.5 call at 187, buy the 14th of April 60 call at 78 cents. Now we're going to generate 109 in net credit. This is going to push that lower break even down from 56.77 down to 55.68, giving us more cushion, more room for protection in this case. The pros of using the butterfly is it lowers the break even more because you're effectively selling at the money. You're getting a new premium at the money at this time, so you're getting a higher premium than trying to create the Condor. It does lower the monetary risk even more, and it increases the return because we're getting a much higher premium, a $1.09 net credit for this pair call spread as opposed to 43 cents for creating the Condor position. The cons of the butterfly is that one side of the trade is going to have to be managed regardless of what happens. If the stock continues down to here, yeah, your short call expires worthless. Your two short calls now expire worthless. My apologies. This call expires worthless. So your bear call expires worthless. Your other short call expires worthless, but you got to make sure that you sell to close this call, because if you leave it open and it's still in the money, well, then your broker is going to require you to buy shares of stock at 55. If it goes the other way and it moves up, well, now you've got two short calls in the money. This hasn't kicked in yet because the stock's trading between your strike prices. You're going to have to buy to close at least one of these short calls because only one is covered by the initial Bull Call Debit Spread. That's always the tricky part with the butterflies. There are benefits, and you see them here. You lower the break even more compared to the Condor. You lower the risk even more. You increase your return, but it always leaves you still with the two ways to lose that you have with the Condor. We can be assigned on that extra short call now if the stock is between the strike prices, anywhere between 57.5 and 60, because that extra short call is in the money. And as we had with the Condor, no big deal. We know it's there. We've got to put up that additional monetary requirement. The sentiment when we would use this, stock will stabilize or trade near the short option strike prices. We want to give ourselves a little bit more breadth in the upper and lower break even, but we are making the decision that we will have to manage one side of that trade or the other, regardless of what happens in the next 6 to 8 days to expiration. All right. Management number 6, very similar to management number 4, but your sentiments changed. Management number 6, close and do the opposite. Our spread is moving against us. Our triggers and alerts have been hit. We've decided to close the spread, and on April 6th, we would have taken a 26-cent loss. Now that our sentiments changed, we're not going to open a new Bull Call Debit Spread. We're not going to use that fourth adjustment and just roll down the Bull Call Debit Spread because we're more bearish with whatever news came out, whatever we did with that first step evaluating management number 1 of do nothing. Why did the fall happen, and what are our expectations going forward? Well, the fall happened because something came out related directly to the stock. Our sentiment has changed, and we now think over the next 2, 3 to 4 weeks the position is going to be bearish. So we're not going to open a Bull Call Debit Spread. We're going to close our Bull Call Debit Spread that failed, and we're going to go ahead and enter a bear put debit spread. Let's sell the 29th of April 62.5 put at 411. Buy the 29th of April 60 put at 550. Add in the loss that we realized of 26 cents from closing the initial trade. We have a new net debit of 165 for our 2.5 points. I'm sorry, it was a 2-point spread. It was a 60 and a 62. I apologize there. I meant to change that. April 29th, the weeklies, it only offers 1 point, not 1.5. So it's a 60-62. It's a 2-point spread. So the max return is 35 cents if we get the 2 points back. If the stock's trading below both strike prices at expiration, a 21.2% return. That's even factoring in the loss of 26 cents. The pros, potentially we can turn a loss to a win following our new sentiment direction for the stock. Some news came out that we couldn't see in the charts or any other research when we opened the position on March 21st and our sentiments changed to bearish. We're going to try to repair it following our new sentiment for the position. The cons, naturally, we can still get hurt by the whipsaw effect of the stock. If we're wrong and it was just an overreaction to whatever news came out, stock starts to move back up, we'll start to lose on our bear put debit spread. Depending on what's available to get the premium that you need to repair the position, you might not have the same probability that matches your trading plan. I might have to open this new spread at only a 65 or 70% probability to get the return that I want to cover the loss that I took on the initial trade. Usually when this is done, just like management number 4 with rolling down the spread, factoring in the loss, you see a lower return than you initially expected from the first position. Have to evaluate again. Is it worth it to do the management to maybe go out 3, 4, or 5 weeks in time? Well, it turns a loser into a winner. So if it works, yes, it's worth it. But is it worth it to extend beyond that if your return now that you can find with a spread you like on this position, now that your sentiment is bearish, if it's only a few percentage points, 6, 7, 8%, is that affecting your trading plan too much? Of course, the sentiment here changed to bearish. You feel the underlying will continue to move a downward trend. You move from a bullish spread into a bearish spread to make up the losses that you took on the initial trade. All right, and finally, management number 7, the pendulum adjustment, same that we could do for a credit spread position. I would not have done this on KSS on April 6th. I wouldn't have done it right now. This is best used if the stock falls between the strike prices. But what we do with the pendulum adjustment is we're going to convert the bull call debit to a bear call credit spread with one move. Our original position with a loss of about a debit, I should say, of 177 was we bought the 55 call and we sold the 57.5 for a profit of about 73 cents. Now that the stock is being threatened, our sentiment has changed. We're now bearish on the position. We're going to sell to close that 55 call at 338, and we're going to buy an out of the money call, same expiration, for only 78 cents. We're going to swing this over here as a pendulum. Just going to swing it over, and we're going to turn our debit spread into a bear call credit spread with a new net credit of 83 cents. This one's pretty high, and the reason why it's high is because it wasn't below the short call strike price yet at 57.5. That's when we'd normally look to do this, or in a bull put credit spread. This was still above, but we wanted to show what it would look like. So we swung the 55 up to the 60. We keep a 2.5 point spread, but with one move only. We're now in a bear call credit spread following the new sentiment. If the stock continues down, stays below 57.50, we have a profit. The pros of this adjustment: we can convert a winner to a loser with only one adjustment. The cons, again, you can lose with the whipsaw effect if the stock starts to recover. The return, as before we saw with rolling down with number 4 or closing and doing the opposite, is typically going to be lower than the initial position. This one's higher because it wasn't the right time to do it. It wasn't a defensive move. We're just showing the example. We'd want it to be below 57.5 between our original sold 57.5 and our 55 bought to use the pendulum adjustment. You could use it here, but you're taking a chance because it's not falling yet. It's not down below the short call strike price. And yes, now we do have to put up again, as we did with the Condor and, of course, with the butterfly repair, we have to put up a monetary requirement because we're in a credit spread now. We're no longer in a debit spread. So the sentiment, when to use it, the stock is between the strikes. We feel it will continue down in price. We're going to turn the bull into the bear. Again, this best works if you have 5 days or more left to expiration. It's not something you want to do the day of expiration because both those options are going to be so close to intrinsic value. You're not going to get any benefit. You're going to put yourself almost in the same situation. You're going to have about the same loss if you do that in this case. Now, what's the 8th one that's missing? Of course, when we take a look, let me go back up here for 1 second to our previous position. I want to go to our original position here. Excuse me. There we go. All right, so our original position back from the previous slide, we sold the 57.5 call and bought the 55 call for the debit spread. The 8th adjustment that we use in the debit or credit spreads, that's not here in the debit spreads, is if the stock moves down and starts to threaten the short option, my sentiment has changed and I'm more bearish, I would buy to close the short put, which might be expensive, and leave the long open. Because now if the stock continues down in price, if I get a higher value for this put option that counters the original, well, I would have received a net credit in the credit spread. Now I have to add in the buyback cost. So that, let's say, gives me a price of $2 for this long put. If the stock continues down, it goes to 54, 53, or 52. As we get closer to next week's expiration, I might be able to sell to close that put for 210, 220, 230 and make a profit on the position. This doesn't work in a debit spread. So we're in a bull call debit spread here, not a bull put. The stock's falling and I buy to close this short. If it continues to fall, I just lose more money on the long. That's not helping me. That's why there's only 7 managements we discuss on the debit spreads instead of 8. that one's not there. And what you never want to do, in my opinion, what I never want to do is as the stock is falling, I don't want to sell to close the long and say, okay, well, I'm going to leave this as a naked call position by doing that, which is a bearish trade. Because now I have a much higher margin requirement I have to put up. I'm in a naked call position, which means level 4 trading. That's usually not what I want to do with this portion of my portfolio. I don't have that high margin to cover a naked put if it was a bear put debit spread and I did that, or the naked call here, which I couldn't do in my account anyway, because you need level 4 trading to do it. So that's why you don't do it that way. And that's why there's only 7 that we recommend for the debit spreads as opposed to 8 that we do with the credit spreads. That one of just buying the short to leave the long open is missing because that's not what we see in those positions. So the key here is always remember, of course, what are your triggers? Set up your stops to what you want to see. And I just went too far. Sorry about that. There we go. Okay, so you always want to remember the 1% rule is a good one to use. It's one we prefer to use. You can use a different one. But any criteria, technical criteria that you use to get into the trade, if those reverse, those should be alerts where you could consider it might be time to manage the position to avoid a larger loss. And at any time, we highly recommend in any spread, credit spread, debit spread, even if you're using the at-the-money debit spreads, which have more of a 1-to-1 risk-reward ratio than an in-the-money debit spread, you want to try to control that to 50% of the maximum loss. You don't want to let these spreads go to a 70, 80, or 90% loss, because then it's much harder to get those wins needed back to replace that loss. You want to kind of control it in both ways. We always talk about that with the credit spreads. With an in-the-money debit spread, we want to do the exact same thing. But when it is triggered, of course, when your alerts trigger, before doing any of these 7 adjustments that we just reviewed there for the debit spread, ask yourself those important questions. The first questions you want to ask are, what changed? We know what changed. Our technicals changed. The stock moved opposite our direction. But why? Was it related to just overall market conditions? Was it directly related to news or some other event that came out on my stock directly, or the sector my stock is in directly? And what are my new expectations? That's going to help you decide which adjustment and which sentiment you might want to use for these different ways to manage the debit spread.